Our next guest, though, believes there is more uncertainty under the surface. Joining us now, BTIG's Jonathan Krinsky. Welcome back. It's good to see you. I've had technicians tell me this week alone that we're still in an uptrend. Do you beg to differ with that?
You know, the market really is in the eye of the beholder right now. And, you know, you mentioned the S&P is up about 6%. If you look at the equal weight S&P, it's about flat on the year. And then you go down the cap scale, small caps are much weaker and micro caps are churning on 52-week lows right now. So the question really is, you know, which one do you believe? And we continue to see more and more evidence that suggests the market continues to thin out, and ultimately, you know, that's a tale that we see over and over throughout history at market, whether it's major peaks or the end of bear market rallies, where breadth continues to thin out, and ultimately, once those fewer names succumb to the downside, that's what leads to the weakness on the cap weighted index level. And if we mention that, if we're talking about the Nasdaq specifically itself, well, the Nasdaq Composite got back to its February highs, more or less. Internally, it's a much different picture. So at the February highs, you had about 57% of the Nasdaq above the 200-day moving average. On the recent move up this week, we only got about 37%. And then you look at the credit side of things, you can look at CDS on the tech sector, and that's actually wider than it's been even at the fall, at the wides we saw last fall. So credit and market internals are giving a much different picture than even the cap-weighted Nasdaq itself is showing.
I feel like you got to be careful, though, perhaps if you look at, let's just say, market breadth and say, well, 20 stocks have carried the whole thing for the S&P 500. Without them, we wouldn't be up. In fact, we'd be lower. I mean, we've been here before, and it didn't really matter. You know, the mega caps had carried us at times over the past few years, and it managed to actually carry us pretty far, no?
Yeah, I mean, look, that's been the playbook. We actually think the reason the Nasdaq has been so strong, it's been a beneficiary of the selling in banks and other areas of the market. I mean, if you're a long-only money manager with a cash mandate, you can't, you know, you have to be fully invested, and you just sold a bunch of banks and other cyclical areas of the market. Of course, you're going to probably put that money into tech and maybe some defensives like staples, healthcare, and utilities. You know, what's concerning is just the persistent weakness in the banks, in small caps. Biotech continues to remain weak. And then recently this week, the biggest development is probably in the industrials, which had been, you know, kind of the holdout of the cyclical trade. We're seeing transports and machinery stocks and truckers recently starting to break down. So, you know, that's not giving a great message. And then you have this other backdrop, you know, when you put everything together, you know, interest rates continue to fall, and we're seeing that correlation shift. Last year was all about stocks and bonds being highly correlated as the market was concerned about inflation. We're starting to see this year stocks fall with interest rates, which tells you the market's starting to become more concerned about the economy.